All right. So day 4 of Technical Analysis Wednesdays today, guys. We're continuing off of last week with our patterns. Just a couple intros in the beginning, just a couple little continuations, and then we're gonna jump into indicators. So we're gonna look at long-term indicators, which can also be applied to short-term. We'll talk about that in specifics. Indicators are huge, guys. I mean, just pick some that you like, find the ones that work for you, leave them on all of your charts. I mean, they're great. Add them to your charts, keep them on your charts, and they will do you wonders with telling you what to do, guys. Hope you like it. Enjoy. All right. Cool. So we're gonna finalize our trend line stuff and setup today, and we're also gonna start looking at indicators. So get up Yahoo Finance, the one, the only. But first, we're going to continue with trends from last time. So, I think probably got like right about here on the camera, so I'll try to draw over here. So we talked about ABCDs last time. We've got our A, our B, our C, and then the D, right? So we've got that down. We're going to talk about a little variations on that overall high day pattern that we were talking about at the end of last week. So when we've got like a big run up, and then some consolidation. We talked about the C setup, and then we talked about how it's got to break this high day. Another setup that's kind of based off that is the cup setup. So sometimes we get up to this high day, and then we might stagger a little bit down to here. Now this is a little risky, so this is kind of like you're freaking out a little bit if this is you and you put a trade in right here. If you put your trade in like somewhere around here, your stop loss is probably somewhere over here. But with this cup, you just let it play out. Sometimes it'll go down, you'll stop out, and that's that. Or it could do a nice little retrace up here, and you see a little handle, it's a cup. It's called the cup pattern, and you'll go up. So it's just a little bit of a delayed ABCD, but there's a little bit of a, kind of like an extra C at the end. That's the cup setup. The next thing we gotta cover, sort of with our, trading alleyways, where we'll have support and resistance, like from the second week, but we're gonna have a run up, so we'll have some gainer going up here, and then we're gonna enter what's called either a bull flag or a bear flag. So the first one we're gonna see is a bear flag, and we start to go in this downward channel off of a run up. So this will be a run up, and then we'll see this support here, resistance here, and it goes down in sort of like a flag pattern is what it's called. A lot of the times on these and with the other one, it's a bull flag, so we'll go up, we'll have a run up, and then we'll see the same thing, but it's facing up, so we'll have, going around a price line like this, we'll have a support and a resistance. With these are called flags. You just got to be careful with them. Wait for it to break out, and usually the first price action it goes, so if it goes down off of this flag, or if it goes up off of this flag, those are usually some pretty solid short-term indicators for gains and losses. So those are big setups. With these flags, these are on the new, like the high day gappers, you're gonna see them up and down. Just trade them like support and resistance lines. Okay, cool, I didn't forget to start. All right, those are the two big ones we didn't really touch on yet. Most of the other stuff we're gonna see, you can it's just trading off of those support and resistance lines, and sometimes the psychological levels of where you think you should be. We might get to a couple more, but we're going to talk more about indicators today. So let's go to some stock, I don't know, McDonald's, if I can spell it. And we'll pull up full screen. So, indicators. These are going to be huge for long-term stuff. So if you're looking at when you want to trade a stock, if you think it's going to go up and down, or if you think it's blah blah blah, not for like, just investing in companies you like, but maybe we'll go to the 5-year chart, thinking, okay, is this a good time to get in? Is the price too high right now? Blah blah blah. So that's what indicators are terrific for. So the first one, which is like the big one, is the moving average. So we're on a 5-year chart, weekly intervals with our candlesticks, or daily intervals works too. It'll probably take us down to like a yearly chart or something. So with moving averages, the common ones are the 50 MA for the 50-day moving average, the 100 MA for obviously the 100, and the 200 MA. Now these averages are going to be huge for looking at big moves in the stock, big support levels in the stock, and big resistance levels in the stock. So every single one of these is going to be, we can see here it hit the 50 and dipped to the 100. It broke through both of them, and now we've got a downtrend. Whatever stock it is, if you see it up off of the MAs, then that's when you're going to have your high flying, and it might crash down, like right here, crash down to the 50 MA, and we'll see it, it goes off these moving averages. So the 50, the 100, and the 200, those are some big moving averages. You'll see a lot of people use all three of those. And if we look at, I think back here we might see, so back here, looks like the 200 was at 120, the 100 was at 116, and the 50 was at the bottom. So the 50, the 100, and the 200 average. When you see the 50 average under the 200, that's usually signs that the stock or whatever it is undervalued, and it's kind of scary because you'll see a 50 here. Once the 50 crosses the 200, you're usually going to see some pretty significant downward price movement, and at that point you really want to start thinking about the company and saying, are they going to recover from this? Because that's a big move. It's called a death cross when the 50 crosses the 200 moving average. And we see here with McDonald's, they were a solid company. They had solid money coming in, blah, blah, blah. Their stock recovered, but it took, from November to December, like December they started having an uptrend. It took until like halfway through February for that 50 to cross the 200 again. Or wait, no, it took like a month, but then it had to get over to 100 again. This is the 200. Oh my god, no way. Okay, cool. So this is the 200 and this is the 50, and you can see once it bottomed out, it took a while for that 50 to retake the 200 because it is really bad for the 50 to cross the 200. That usually means you're going to see at least for some reasonable period of time a down market. What you want to see on stocks is the 50 at the top, the 100, and then the 200. So 50, 100, 200. And that means it's healthy, the stock's got consistent growth, no one's like messing around with it. And we can see McDonald's had that for a while, and then recently they had this big pullback and the 50 went down, and now we see again, we've got the 50 under the 200. So we might see some downward price movement if we can't get the 50 to consolidate back above the 200. These are going to be really good for looking at it long term, when you should get your entry in. If we've got like a solid market like this versus a riskier entry around a market like this where you see some crossing over, it's not looking too great. Now, indicators all build on themselves. So the more you have, the better, you're looking at things, the more information you have. Let's talk about moving average envelope is on Yahoo Finance. You can usually just use the default settings for this. And it's just like the moving averages, but it kind of gives a little variability to it. And we can see when it goes out of the envelope, it usually tries to come back into it. Same thing here, it went out of the envelope, it tries to come back into it. The middle moving average is whatever you set it as by default. It's the 50 moving average. So we can see the 50 moving average is this line in the middle, and the envelope is just variability based around that. And we'll see the stock when it goes out of the envelope, try to go back in. I'm not a huge fan of using the moving average envelope for stuff like this. A really good one though for looking at variability is Bollinger Band. So Bollinger Band does a little bit of the same thing, but it's based off some more specific algorithms that look at periods and blah blah blah, SMAs, or standard moving averages and stuff. Not gonna get into technical stuff, but it's a lot more precise than your moving average envelope. So you can see with the Bollinger Bands, we've got some more specific price action, and we still see breakouts, and when it breaks out, it comes back quickly. But we see with these breakouts, it's actually affecting the Bollinger Bands and the variability. So the Bollinger Bands are really good for looking at stuff and seeing if it's out of the envelope, because we see, some of these downtrends are all following the general Bollinger Bands, just a little bit under it. And the uptrends too, those are following the Bollinger Bands. Bollinger Bands are really strong, really great for if there's a really, really fast price movement, like right here there was a really fast price movement, you look at the Bollinger Bands and you say, okay, how's it doing compared to those? Is this really fast? Should we just chill out for a sec and let it get back into the Bollinger Bands? Because you usually don't want to buy when you're extended out of the Bollinger Bands. And there are exceptions to that, like here it was out of it, but I mean, this is one stock. This stuff can be applied to like pretty much every stock, right? So Bollinger Bands are good for showing variability, and when you're out of the Bollinger Bands, usually it's some really volatile markets and you're going to see some rapid price movement. All right, so next one we're going to talk about, we're going to just go through these commonly used ones. We've got RSI, and RSI is, just leave everything at default. RSI goes along with stochastics. So with RSI, you can see, it's really great. I mean, all this stuff's great for long-term stuff. You'll see this is basically measuring momentum. This is like a momentum indicator. So when we have really, really high momentum, like this was a huge upswing, we'll see insanely high RSI. And usually it'll go back and forth. So then we saw low RSI. It was a little dip here, and then back to around the middle. Above 80 is very, you can expect some significant pullback because it's just huge uptrend. And then below 20 is, so 80 is overbought, 20 is oversold. So below it, you're gonna see, it doesn't look like McDonald's ever really got too oversold. We see really low RSI, which means really low momentum here where there was a big dip, really low RSI momentum here where there was a cross down. And even at the shorter term, we can look at it and we can see, okay, the RSI was very close or very low, blah, blah, blah. And you can use this for trading in the future. You can look where the RSI is right now, and you can say, maybe if we go back just a little bit, if we say the RSI is at like 70, and we see this pretty consistent, stable momentum, we can say, okay, there's some pretty good momentum behind this. Set your stops, because obviously it didn't fall through because we saw a significant drip in the RSI. And a lot of this is tougher to look at like short term, but you can look at the overall market performance a lot of the times to determine the RSI. And you'll see big drops that coincide with market drops. RSI is a little bit, it's not the greatest decision maker, but when combined with stochastics, it's extremely effective. So stochastics over on here, on Yahoo Finance, on most of the things we'll look at, just leave it at the default settings. And this is where we really start to see, should we make a trade on this or not? So if you look at the history of it, stochastics and RSI, really closely related. I mean, you see dips in RSI means a dips in stochastics most of the time. Usually overbought, oversold. So, if we look back here, it was super high. It saw a slight pullback down to around the middle of the stochastics before going up again. And then we saw the stochastics were screaming, they were really high. So the stochastics dropped down, the price dropped down. And that's just more momentum. It's measuring the momentum, but it doesn't it's a lot easier to read a stochastics chart. So you see the stochastics are up really high here, and we see the prices going up really high. So usually it goes back and forth, right? You have really high stochastics, you can expect it to go down. And just because it's really high doesn't mean there's not any upside. I mean, we saw this big stochastics pullback, but it was barely a pullback in the real world, right? But a lot of the times they're going to be really good. If it's super high stochastics, you might want to wait for a lower stochastics level or a dip to buy. Same thing basically everywhere. We saw this big dip in McDonald's recently. I guess that's like the beginning of 2018. Huge RSI here, and then we had a big dump, and then the stochastics stayed towards this 20 oversold level. Oversold level. So we saw the price was going lower and lower, and the stochastics are going lower and lower. So when you see really low stochastics, obviously, you think they're going to go up. So then we saw that up movement, and it really is just people buying and selling back and forth, and it's measuring like the stochastics right now, right? Pretty high stochastics, but they did have like a slight dip. So depending on how the market takes it, we see the 50 is really getting close to that 100 moving average. But it's, it's kind of like a general uptrend. We can see a resistance here, a support here. We can go in and draw that. Obviously, that's not what we're talking about today. But if you're looking at trading, stochastics is huge. If you see really high stochastics, you might want to wait for it to lower. And then once it's lower, it's usually a better time to buy with lower stochastics, which is going to mean lower momentum. So less people on it gives you a better price for it. Because you're always trying to get in low. Or the opposite, right? If you want to short and you see the stochastics are super high, then you can you know, if you see really high stochastics here, here, maybe you want to short a position when the stochastics are really high, because you know that there's more than likely it's going to have to come back to this. It's got to drop eventually, right? It can't just go up forever. It's going to have a slight pullback. If you can put a short position on that, that's huge, right? On my phone. Oh, it's over there. All right, let's go through. Most of these indicators are long-term. We're going to talk about just a couple, probably like one short-term indicator at the end of this. So MACD looks at volume and people going in and people selling. So I'm just going to get rid of these other two real quick. I'll leave stochastics because stochastics is pretty good. We'll go in like the 2-year chart, no, 5-year chart. Yeah, zoom out a little bit. Okay. So MACD is looking at people buying and people selling and where the money's coming and where the money's coming out. We can see, just like stochastics, up and down and up and down, and it goes up and down, right? So when it's really high, you can expect it to go down, and when it's really low, you can expect it to go up. But it's important to know, you know, these are really long time periods. Like, this is an entire year. This, you know, this uptrend was an entire year, right? If you zoom in with these, and maybe we just go to the yearly chart, you're going to see a very different chart. You're going to see more shorter term stuff. So these are applicable in long term, looking at the overall price of the company, but also looking at your, you know, if you look at the 1 month chart, you can look, if you're thinking about getting in, you might see that the stochastics are high and that we're sort of at the top of a MACD cycle. And by cycle, I just mean it goes, you'll see the volume go down, and then, let's try to zoom out a little more. So you'll see these are volume bars on the towards the center. So we see volume up, volume down, volume up, volume down, volume up, and then we had a big volume up, and then volume down, big volume down. So when the volume, we've got a lot of buyers here, and this is going to go up, so we're going to see our price increase off the MACD. Likewise, we saw the MACD go down, so, you know, if we're trading and we're right here, and we see this, we see the MACD start to correct itself and maybe hit like the middle, that's when we're going to want to say, okay, we should get in. We see that the MACD is going back up. We see that the RSI probably shot up about to 60 if we're looking at it right here. And then we see an upswing, and we also see it going, the MACD goes all the way from here to its upward curve. And then usually, you know, if you're trying to time it, then you'll sell on the upward curve or just hold long term, at least with big companies. So it's really good for looking at the flow of money in and out of a stock. And it works long term, and if we go to like a 6 month chart, we can still see these volume bars are going up and down, and we had this big up here where the volume kept going up, and we saw that the stock price kept going up. So there's more tension on it, more people getting in, blah blah blah. The stock price does better. Right now we see we're sort of in an interesting spot because we've been above the MACD for a while. We might see it start to retrace down because we haven't had a down volume in like 2 or 3 months. So that's MACD. It works in conjunction. Everything works in conjunction here. I mean, there's tons of these indicators, guys. I'm just gonna, like, there are so many. A lot of people find ones that work really well for them. I find these to work really well. A lot of people look at, you know, some of these are just so weird. I mean, has anyone ever heard of Ichimoku clouds? Because I sure haven't. You can put Ichimoku clouds on it, and God, if I knew what that meant, I would be a psychic. I mean, I'm sure all of these have descriptions, and all these indicators, you know, you can go, and whoever the heck makes them, you can go to their website or whatever, and they'll be like, this is what it does, this is what it measures, this is why we made it, blah blah blah. I mean, those are the ones we looked at were the biggest ones, and those are the ones that most people are going to be trading off of because they look at market-wide performance. Staff meetings, right? Yeah. And how like the overall market's looking at the stock. A couple other big ones though. MACD, moving average, that's the huge one. Pivot points, oscillating. These are all, there's just so many of them. I'd say the one for short-term trading is going to be our VWAP. So let's go. Alright guys, so looks like the video cut out, unfortunately. We were finishing up with our long-term indicators, and we were getting set up with going into short-term indicators. So I guess we'll just continue with where we were. Yeah, it kind of sucks. I don't really know why it stopped, but what are you gonna do? So we just finished talking about MACDs, RSIs, stochastics, and moving averages and Bollinger Bands. Those are going to be your biggest ones for looking at things long term. What we're looking at here is going to be our short term indicator. It's going to be good old VWAP. So we just pulled up GE in class because someone yelled it out and it worked pretty well. We're going to look at VWAP. It's also called volume weighted average price. The really interesting thing about VWAP is if we go to like a 2-year, like a 6-month chart, you aren't going to see VWAP at all. But once you go into the short-term charts, like the daily charts, that's when you start to see this red line. That's the VWAP coming up. And VWAP is really useful for short-term trading. It acts sort of like a support and resistance, but it makes it for you. It's great. So we had this great trend line. We just kind of jumped top of our head. We saw, this was a pretty support resistance-y level. We just drew our little trend line there, and we saw, it broke through it here, came under it, and bounced off of it, scolied around it here. Pretty normal stuff. So if we were gonna go and we were, I think yesterday was when this was up, so this didn't happen yet, and we were gonna day trade GE. We could look at that price level we just drew in. Hopefully, yeah. Oh, wait, that was the wrong price level. My bad. Right about here. And we see we had this candle end here. We had a little bit consolidation around here. It's not the perfect line, but it's a pretty good line. And we saw this top here hit it. So we looked at that line in class, and we were thinking, okay, if we were going to trade this, right, and we were here, we could see this line. It was towards the end of the day, right? So it was going over it, and we knew that this line was going to be a pretty big resistance, and we could expect a downtrend, at least for the end of that day, up until right around here. So we put that in, and it was great. We had our line put in, but what we didn't really have was anything else. If we were trading this and we just saw this chart, like maybe even if we, stop drawing. What VWAP does is it builds support and resistance lines for you, right? So it takes the average price weighted based off of volume. And if we look at some of these big spike ups, right, GE opened relatively high. I mean, it wasn't a huge move, but they opened and they had this big run up. And with the run up, we saw it fall back down, and it went down here, and we saw consolidation at the VWAP. Now, I just want to zoom in on this movement because we talked about it a lot. If we get rid of this VWAP and we just look at this chart, we see maybe a little bit here, and I can't, if we're looking at this and we see that, we might see like a little bit of an upward triangle, but we aren't going to be 100% sure on that. And it's not the strongest. You could see it though. It's there for sure. What VWAP does is it really helps you make up your mind on stuff like that. So add it in, and then we see that, it went under the VWAP, and now it's going up past it. And we could say, okay, this could be potential breakout supported by these support and resistance lines. And even without them, VWAP, a lot of times you can trade off VWAP and just make your lines in as you go. And it works really well because it is a terrific, it's very consistent. And we see the price is usually going to want to come back down to the VWAP. So I guess that was the end of that day. And we saw, a slight downtrend back down to where this line was that we drew from months back, which is really important because that's, that line was from a really, really long time ago, but it still mattered in this chart. And even though this was like 3 months ago, we still saw that resistance level because, as we talked about with support and resistance, that's a psychological place where they'll meet, right? So let's go and get rid of this line and just look at VWAP. Now, VWAP is going to be a lot more helpful with more volatile stocks. Here we have, GE. It's a pretty big company. I'm just going to look at what some of the biggest movers were today on Yahoo Finance. You'll just go to the top gainers part under markets, and you can go markets top gainers. Those are going to be the ones that really have a lot of attention on them. It's going to be right here, gainers. And I see a little ticker here. I'm looking at, usually cheap stocks, you'll see more movement, but Loxo was a big mover today, so we'll look at that. Now, yeah, I didn't really think so. Well, okay, so we look at the daily trade on Watts, on Loxo Oncology, whatever that is. And we see they had this big breakout, and there wasn't a whole lot of money to make here. More expensive stocks are usually going to be tougher to day trade. And this is more of like a long-term, wow, this is more of a long-term gain. Dang. Good job to Loxo. Anyway, if we were just looking at this as a day trade, and we saw this big run up, we saw it going up and up, and we saw a little bit of I'm not going to do very too much on trend lines here because that's not what this video is about. But, we see a little bit of a failed triangle breakout, unfortunately. But we see this consolidation at the VWAP, and that's where everyone's meeting up, and they say, okay, are we going to continue this price movement? And as we go through the day, we saw it bounce off, and then down, and then up, and then down, and we finished a little bit high off the day. Now, it doesn't look like a ton of huge penny gainers today, at least not at the end of the market. Maybe they died down a bit, which is unfortunate, but let's see. Top Ships has always been one of the most volatile stocks I could think of. Obviously, you guys see these little tiny dashes. That is because of a lack of volume, right? So Top Ships, their average 3-month volume is going to be around 1.6 million. But today, after market, it was only 560, right? 560,000. And that's why we see with this 5-minute chart, these little blank candles where it opens and it closes at the same price because no one really bought it. There wasn't really any movement. But let's look at the, not the yearly chart. We're never going to make money on a yearly position. Let's look at some of the past couple days with Top Ships because it's usually pretty volatile. We saw this breakout here. Maybe if I go to the 1-minute chart, this will be better to look at. If I can find it. Yeah, here we go. All right, so we're looking at the 1-minute chart. This is very fast. You're getting in, you're getting out. Now, we see this breakout, and it opens really high from the previous day, right? This is the morning. We open at like 1.7, coming off of 1.6. It's pretty big. I mean, good gains. We see a run up to like 190, and it comes back, and it crashes straight through, you guessed it, the VWAP. If we get rid of this VWAP, well, we'll keep it. We see it goes really, really low. And if we're not looking at the future, right, the VWAP is at 176, and the price is at like 168. So we might expect either the VWAP has to come down or the stock has to go up. And usually it's looking at how extreme the difference is. And when you have a really big difference, you're going to have probably some more immediate movement. And this can actually be helped a little bit by the Bollinger Bands, funnily enough. We saw it pop straight out of the Bollinger Bands. And that's when we knew we were going to have some extreme price action because that's a huge increase is going to stretch out our Bollinger Bands and really increase our variability. So when you see really, really wide Bollinger Bands, that's when you can start to make some really nice swing trades. But went back up, broke through the Bollinger Bands, and that's usually when you're going to sell. If it goes, over the Bollinger Bands, you're usually going to see, a short-term pullback. And at the end of the day, it just trailed out. And then it, sunk the next day. It's Top Ships, guys. Really interesting stock. Oh, man. What a company. Anyway, those are your indicators, guys. I mean, I just pick the ones that work for me. And, I go to whatever stock. We'll go to Apple because, it's pretty, it's been performing very well. Okay, so here's Apple. And we see we've got you know, we add our MACD, our stochastics, and it doesn't matter really what the stock is. You can use these with anything, and it's great. So we'll add maybe Bollinger Bands too, just for fun. And I guess I don't have the MAs on here, but I can just put in the moving average envelope. Yeah, I guess I'll put the MAs in. I like they're more accurate than the moving average envelope, which is great because accuracy is key with these. These are going to be big support resistance levels. Or at least the 100 and the 200 are going to be huge support levels. So you know, breaking past those is going to be a big deal. Yeah. So you look at any position. You look at your indicators, you think, okay, maybe the MACD needs to go down a little bit. We need some down volume. Maybe the RSI needs to go down a little bit. We need some down movement. Maybe those Apple credit cards that are coming out just aren't going to be enough for the stock. They're really high on the Bollinger Bands too, so they're great to think about. But if you're getting in long term, just keep getting in, and your prices are going to average out. Yeah. Cool stuff, guys. Sorry the video cut out. I had to do this. I hope this comes together pretty well. I guess I'll try to put like a webcam in the bottom and we'll see if it works. So enjoy, guys. I'll see you next week.